All right, let's jump right into it. Welcome to this explainer, where today we're basically putting on our detective hats to investigate HF Sinclair. They trade under the ticker symbol DINO. Now, on the surface, this massive independent refiner looks like the absolute perfect value play. But as we're going to see, it's actually hiding some really deep contradictory signals. Okay, let's start with this number. 212%. That is the staggering year-over-year growth in Q2 earnings per share that HF Sinclair just posted, hitting $5.31. I mean, when a major energy company posts numbers like that, it literally demands our attention, right? But hold on a second. Right alongside that massive 212% growth, we get a massive warning stamp from Guru Focus. They calculate the true GF value of the stock at just $50.07. With the current price sitting way up around $81, that implies the stock is actually significantly overvalued by 63%. No way. And we don't exactly have forever to figure this mystery out. The ex-dividend date is August 11th, 2026. That's just 3 days away. So if you want to capture that upcoming dividend, you need an immediate verdict on whether this is a genuine value play or a massive value trap. So here is our roadmap for today. Number 1, the DINO mystery. 2, hidden red flags. 3, the bullish green flags. 4, the moat debate. 5, the Guru gauntlet. And finally, number 6, the final verdict. Let's get right into section 1, the DINO mystery and its spectacular surface numbers. This stock has rallied a super impressive 87.8% over the past year. And honestly, it's pretty easy to see why investors are so excited. We've got a share price around $81.41, but a price-to-earnings ratio of just 7.8. To put that into perspective for a second, the industry average is usually sitting up between 15 and 20. Then you add in an elite 19.5% return on equity, a 2.58% dividend yield, and over $10 billion in Q2 revenue. I mean, you have numbers that look absolutely spectacular on paper. But let's flip the script. Section 2, hidden red flags, or what we'll call the mainstream blind spot. Because when you look under the hood, the red flags actually pile up incredibly fast. The overall Guru Focus score is a below-average 68 out of 100. The PEG ratio sits at 1.14, which means the price isn't entirely matching the growth. The price-to-book ratio is slightly elevated at 1.58. The analyst consensus is a lukewarm hold, with price targets implying less than 10% upside. But here's the most alarming part. Right after that massive Q2 earnings beat, an insider dumped 2.375 million shares on August 4th. Someone selling millions of shares near 52-week highs, that is a massive, flashing warning light. And all of this builds into what is probably the most terrifying warning of all: extreme cyclicality. Analyst EPS estimates jump from $5.06 in 2025 way up to $13.24 in 2026. That's a 162% jump. But then look at 2027, a complete plunge down to $9. That's a massive 32% collapse in earnings, right around the corner. A sudden drop like that makes a cheap 7.8 PE look a whole lot more expensive, doesn't it? Let's balance this out. Section 3, the bullish green flags. Because it really is a genuine cash machine. To be totally fair to HF Sinclair, they are printing cash. That 7.8 PE is a 60% discount to the broader industry. Their price to sales is just 0.52, while the industry sits at 1.14. Plus, they generated $892 million in net income in Q2 alone, and an absolutely staggering $4 billion in EBITDA. Make no mistake, when refining conditions are strong, this company is a highly profitable cash machine. And the green flags definitely go beyond just historical cheapness. For instance, they have incredible refining flexibility, which allows them to process discounted heavy and sour crude oils to capture higher margins. They're also planning to spin off their lubricants business. That could unlock a ton of hidden value the market just isn't pricing in yet. Plus, they're heavily returning capital to shareholders, like the $167 million in Q1 alone through dividends and buybacks. And the big players see this. Both Goldman Sachs and UBS have given it buy ratings, with Goldman setting a massive $114 price target. Which brings us to Section 4. The moat debate. Identifiable, sure, but is it weak? First, let's quickly define our terms. A moat is a structural business advantage. In the refining industry specifically, this generally takes two forms. You either have a cost advantage, meaning you operate way more efficiently than anyone else, or you have a pricing advantage, meaning you have real customer loyalty or actual control over what you charge. So how exactly does HF Sinclair stack up here?
Well, Guru Focus gives them a 4 out of 10, rating their moat as identifiable but weak. Why? Simply because of the harsh reality of their industry. Yes, they have a cost moat thanks to that excellent refining flexibility we talked about, but they have absolutely zero pricing moats. Think about it. Gasoline, diesel, and jet fuel are undifferentiated global commodities. There's virtually no customer loyalty. Buyers simply go to whoever is the cheapest, and prices are entirely dictated by the global oil market. All right, Section 5, the Guru Gauntlet. Let's test this stock against the investing titans. First up is the father of value investing himself, Benjamin Graham. Graham loves a low PE, and HF Sinclair 7.8 passes that test with flying colors. The debt levels are great too. But when we compare his strict framework to the reality of the balance sheet, issues definitely pop up. Graham wants a price to book below 1.5. DINO is slightly over at 1.58. Graham wants a current ratio above 2.0. DINO sits just short, between 1.85 and 1.97. So what is Graham's verdict? It's mixed. While the earnings yield is fantastic, the slight misses on the balance sheet and liquidity metrics mean there just isn't a clear margin of safety for a strict Graham-style value investor. He would likely pass on this, or maybe take only a very small position. Next up, let's test the stock against Peter Lynch's golden rules for growth at a reasonable price. Lynch wants a PEG ratio of 1.0 or lower, and he absolutely demands stable, predictable growth. But DINO's reality? A PEG of 1.14 and a wildly cyclical growth rate that, as we saw, jumps 162% one year and then completely plunges 32% the next. So Lynch's verdict is a definitive fail. For Lynch, the PE needs to match the growth rate, and that growth needs to be reasonably predictable. The extreme roller coaster cyclicality of a refiner makes this a hard pass for his particular framework. Finally, let's test it against Warren Buffett's legendary standards. Buffett loves an elite return on equity above 15%, and DINO delivers on that with a solid 19.5%. But Buffett also demands a durable moat and absolute pricing power. That elite ROE clashes fatally with a weak 4 out of 10 moat and zero pricing power in a pure commodity market. Which leads directly to Buffett's verdict: fail. Despite the incredible cash flow and profitability we're seeing right now, Buffett would reject this. He cannot confidently predict earnings 10 years out in a commodity cycle, which makes it totally uninvestable for his strategy. And that brings us to Section 6, the final verdict. A great quarter, sure, but a very cyclical stock. Look, HF Sinclair is clearly a top-tier independent refiner. They just had an unbelievable quarter, their cash flow is phenomenal, and they are actively returning that capital to shareholders. But fundamentally, it's a cyclical stock wrapped up in a commodity business with zero pricing power. When you've got insider selling at the top, a 63% overvaluation warning from Guru Focus, and a massive 32% earnings decline projected for 2027, the risks are heavily, heavily weighted. So I'm going to leave you with this final thought. Are you willing to stomach the cyclical collapse of tomorrow for a cheap valuation and an immediate dividend today? Let me know where you fall on this debate down in the comments. Thanks so much for joining me on this explainer, and as always, keep learning.